Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Thanks for joining us on Money FM 89.3. I'm Ryan Huang, the bigger picture, and we are zooming in on a couple of things, and it's all around tariffs, how that could impact earnings, as well as the global PMI numbers come out this week. And to help us navigate what to expect, we've got Yeap Junrong. He is the market strategist for IG. Junrong, good morning. How was your long weekend?
Hey, good morning, Ryan. My long weekend was good. How are you?
Pretty good as well. Hope you're all rested for what is going to be a very busy week. The earnings season kicks off, and we've got some Max 7 names to look out for. Tesla and Alphabet among the headliners. What are you watching out for on that front when it comes to the numbers?
Yeah, I think so far, if you look at what's happening in the U.S. earnings season, generally I think things are fine on the surface. If you just look at the numbers, currently 12% of S&P 500 companies have reported their earnings. 68% actually outperform in terms of earnings expectations. 55% beat the revenue expectations. So I would say that this is slightly below the 10-year historical average, but overall it still points towards somewhat of a resilience. We are not looking at too much of a recession risk being shown in the current numbers just yet. But I believe that this will be an earnings season where outlook may matter much more than the current numbers. So far in terms of the growth names, we have Netflix going first. They are sort of delivered on the end, but of course they deal with services, and we know that services are sort of slightly spared from all of those direct tariff impact. I think what markets will be watching for will, of course, as you mentioned, Tesla. You know, they will be the company that could be more directly impacted in terms of tariffs. So investors will really want to know how input costs will actually rise, how demand will actually be affected with all of these initial phase of a tariff in place.
Yeah, and talk about earnings, we've got some numbers out from Singapore as well. And just taking a step back and look at Singapore's stock market, we were very close to breaking above 4,000 at some stage, but now things have started to down back a bit. What are your expectations on how the earnings are going to play a part in driving these numbers up for the STI, especially when you look at how perhaps Singapore, in some senses, more defensive as a market?
Yeah, I think there's this general perception that the Singapore stock market could take on this defensive kind of a status across the region, given our more politically neutral kind of a stance. We have seen the STI, as you mentioned, slightly breaking above 4,000, but thereafter, it has actually tracked the global risk environment. It has since retraced quite a bit in that sense. But of course, in terms of earnings, I think it's all about how tariffs will continue to impact. And of course, we've got to look at the Singapore banks. They previously account for close to half of their STI weightage. So clearly, their earnings will play a very key role in determining whether, the STI can continue to move back up to retest the 4,000 level again. My view is that the financial sector may potentially face some kind of a mixed prospects. Of course, we will need to get more clarity from their numbers, which are out the week after. So you'll be releasing on 7 May. DBS 8 May, OCBC on the 9th of May. So I think the current set of numbers may remain resilient. I think the net interest margin may continue to remain elevated, given, the lesser scale of rate cuts that we have seen thus far. But of course, outlook will clearly matter, because if you look at the rate expectations, markets are actually pricing for back-to-back rate cuts after the May Fed meeting. So that does point to some form of an aggressive rate cutting cycle. It could reflect a higher degree of a growth risk. So we really got to keep a lookout on that, because if this were to play out, I think the net interest income for the banks will clearly take some form of a hit. And in terms of the non-interest, I think fee income, wealth management recovery, those will be closely watched as well. Those tend to track the market conditions quite closely. So with the recent sell-off in the markets, how that will be impacted, I think investors will be keeping an eye on those as well.
Yeah, talking about clarity in numbers, we could get some to the extent of the PMI numbers coming through from a couple of places. This will give a glimpse into how all the tariff talk and tension is going to be weighing on sentiment. What are you looking out for on this front? How much will that go into feeding into the Fed's rate decision?
Yeah, I think for this week, we clearly have a series of a flash global PMI numbers. And as you mentioned, amid all of this tariff uncertainty, I think it will be reflected to some degree in some of those numbers. If you look at the current market expectations, manufacturing and services conditions for major economies such as US, Eurozone, those are expected to ease. If you just zoom into the US numbers, the manufacturing side numbers are expected to ease into contraction at 49.3 versus the 50.2 in the previous month. Services, while some may argue that services may be more stable, is less directly impacted by tariff, but the indirect impact, should see it ease to 52.9 versus the 54.5 in the previous month. So overall, I think market has been riding on this view that with all of these trade tariffs, no doubt global supply chain may be hit. They are expecting new export orders to slow, input costs to rise, and of course, how much of this will play out will definitely be one to watch ahead. How demand may hold up amid the uncertainty. Of course, we will want to see some form of a tariff being short-lived to prove to markets that PMI damage will be muted. But if not, if we were to see tariff being dragged on for longer, I think the structural damage could really drag on for longer.
Yeah, Junrong, with all this uncertainty, it has certainly moved a lot of capital flow into safe havens like gold, which is up over 1% in the latest session. For year to date, up 28%. Year on year, up over 44%. Where do you see this going? Is there any signs of this being overbought?
Yeah, I think if you just look at near-term technical conditions, I think it has been screaming for overbought conditions in place. But if you look at some of the fundamental catalysts, it really does seem that all stars are kind of being aligned. Of course, we have the US dollar weakness really playing a role in supporting the strength here. We have market really pricing for this increase in geopolitical risk premium, kind of capturing some of the US tariff fears, some of the taxation concerns as well. And not to mention the central bank's rate cutting cycle has also increased gold's preview. And in terms of some of the statistics that we have seen, central bank also continue to load up on gold consecutively for the past few months, especially in terms of the emerging economies as a bid to really diversify the reserves away from the US dollar amid all of these trade uncertainty. ETF buying has also seen a slight tick up. So all of this does seems to suggest that the demand for the safe haven gold does seems to be strong. And I'll argue that in an environment where really investment alternatives are kind of scarce, it really highlights gold as a potential hedge against any form of a portfolio volatility. But of course, in the near term, I'm slightly a little bit more cautious. I think, as you mentioned, it does seem to be pointing to some form of overbought near-term technical conditions. Even if you look at some of the investors' positioning, long gold, net long gold, it really seems to be the overcrowded trade right now. So I think investors jumping in at current point in time do really have to take note of the risk reward. And to me, I believe that buying on weakness will still be the strategy. At current level, it does seem that the risk of being caught in terms of any pullback, it does seem high at the moment.
Yeah, for now, gold is shining quite brightly. Prices above $3,300 right now. And helping us out this morning to navigate what to expect in the coming days, Yeap Junrong, he is the market strategist for IG. Junrong, thanks for your time and have a great week ahead.
Thank you so much, Ryan.
Catch up again soon. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.